Dear listeners, today we will examine in meticulous detail one of the sharpest minds in the financial world, David Tepper, a living legend of the hedge fund industry, and his famous next-generation technical analysis approach that completely shatters traditional molds by blending macroeconomics with price action. Put on your headphones and lean back, because for the next 10 minutes, we will enter a mindset that will radically change your perspective on the market. While many traders perceive technical analysis as merely colorful charts trapped on screens, candlesticks, or lagging indicators like RSI and MACD that everyone has now memorized, David Tepper proves to us that price is actually a result produced by a massive global machine. If you want lasting success in this den of wolves, the financial markets, you must understand not just where the price is going, but that massive force, those invisible hands pushing it there. Now, let's be honest. David Tepper is not a technical analyst in the classical sense. In other words, when you sit at his desk, you would be wasting your time looking for complex indicator sets or classic head and shoulders patterns on his screen. However, this absolutely does not mean he doesn't read the price with a technical eye. On the contrary, Tepper's approach is built on a magnificent mathematical combination of price action, global macro, and systemic liquidity. In his world, technical analysis is not about searching for simple geometric patterns or imaginary support and resistance lines on a chart. It is the art of detecting when a price is structurally wrong. Tepper's technical perspective focuses on this vital question. Does the current price reflect a rational reality, or is it a temporary but violent overreaction by the market? It is the minority that can understand this difference that creates a billion-dollar edge, a market superiority. So, what tools does Tepper use? The technical tools he employs are far beyond the ordinary. Rather than trend lines on charts, he reads movements in credit spreads, distressed bond prices, volatility spikes, and, most importantly, those panic-selling behaviors we all know as technical signals. Consider this example. If the value of an asset has dropped 80% below its nominal price, say, to $20, this is the strongest technical signal for Tepper. This situation indicates that the market has overshot, meaning it has surpassed its target and moved into an irrational oversold zone. It's like a bow. The further you pull the string, the more violently it returns when released. Tepper calculates with technical genius exactly when that string is at its breaking point. Tepper's unique system actually consists of a three-layered hierarchical structure. At the very top of this hierarchy, which every trader must integrate into their strategy, lies the liquidity layer, acting as the main motor of the system. Tepper always starts with these fundamental questions. What is the Federal Reserve, the Fed, doing? In which direction are interest rates evolving? Is fresh money entering the system, or is money being withdrawn from the market? This layer is the true compass that determines the main direction and the current speed of the market. If liquidity is increasing, every dip you see on the technical charts is merely a temporary deviation for Tepper, an invitation to buy. The second layer is the expectations layer. What is the market pricing in for the future right now? A looming recession or a recovery story. This layer is the psychological ground that determines the timing of the trade. The third and final layer is price, the actual technical layer. Is the asset fundamentally and structurally cheap enough? Is there panic pricing? Have spreads widened excessively? This is the layer that determines that critical entry point where you pull the trigger. When we deconstruct Tepper's signal logic through the eyes of a trader, we see a perfect high-conviction trading model. For an entry signal to form, the fact that the price has dropped means nothing to Tepper on its own. If he sees a panic sell-off accompanied by a volatility spike, a crash in bond prices, and spreads moving beyond rational limits, while simultaneously knowing that the Fed is supporting the system or the government is preparing a massive intervention package, this becomes an unmissable, long opportunity for him. On the sell side, when extreme optimism, narrowed spreads, bottomed-out risk premiums, and a rising interest rate cycle come together, he understands with technical certainty that the time to exit has arrived, no matter how much higher the price goes on the charts. The biggest feature that sets him apart from his competitors is that he does not fall into the famous one-dimensional view trap that plagues most traders. As you know, most traders get disconnected from the world by only looking at the chart on the screen, while most institutional investors get buried in macro data and miss the dynamism of the price at that moment. Tepper, however, locks these two worlds together with steel cables. His ultimate weapon is the formula. The price is structurally wrong, but macro data and liquidity are moving in the right direction. Remember the 2009 crisis in particular. The stance Tepper displayed when the global financial system was thought to be ending is the best example of this. While market charts screamed that banks would disappear and prices would go to zero, he read much earlier the macro reality that the government would never let these banks fail, and the fact that the Fed would provide unlimited liquidity. He made a historic purchase, stating, "The market is mispricing this. This is an overshoot," and multiplied his fortune. Tepper's area of expertise, distressed assets, is actually the product of technical genius. If he sees a recovery potential in assets that the market calls trash, those that have fallen from $100 to $20, this price dislocation is a billion-dollar gateway for him. However, the critical point here is this. Tepper never acts blindly with a catch-the-falling-knife mentality. Data, macro, and price must always meet within a specific range. Furthermore, Tepper is not an overtrader who transacts constantly. Patience is the most solid part of his system. He can wait months for the right setup. He never opens a large position without seeing a catalyst, a concrete event that will trigger the price. His words should be pinned to all of our screens. It is not enough for an asset to be technically cheap. You must also know why it will rise and what will trigger that rise. Regarding risk management, Tepper actually harbors a very conservative mathematician beneath his aggressive exterior. He generally keeps leverage to a minimum. His goal is not to gamble in the market, but to achieve sustainable and massive success. He builds every trade on 3 different scenarios: worst case, best case, and most likely case. This preparation prevents momentary market volatility and noise from disturbing his nervous system. His emotional control is legendary. Panic and FOMO, the fear of missing out, never find a place in his strategy. In his own words, sometimes doing nothing and waiting in cash is the most profitable trade one can make. Of course, he made mistakes and took wrong positions throughout his career. But what carried him to the top was his ability to pivot and update his system rather than stubbornly clinging to his errors. Now, let's expand a bit more on credit spreads, Tepper's favorite technical indicator. A credit spread is the difference between the bond yield of a risky company and the yield of a risk-free government bond. Just as we call it a breakout when price breaches a resistance in technical analysis, for Tepper, a sudden widening of spreads is a technical sign that dynamite has been placed under the market. If the stock price is falling while spreads are narrowing, this is a bullish divergence for Tepper. It means the market isn't actually that scared. A technical reading at this depth transforms you from a mere chart reader into a market strategist. Tepper isn't interested in the color of the candles on the chart. He is interested in the cost of the credit that forms those candles. Another secret hero of Tepper's success is his ability to read government policy. He sees the market as a playground and knows very well that the rules of this game are set by central banks. He is the most aggressive practitioner of the "don't fight the Fed" rule in the world. If the central bank has shifted to an expansionary policy, all sell signals on the charts are invalid for Tepper at that moment. Instead of swimming against the current, he chooses to put the power of the current behind him and fill his sails with the most undervalued assets. This is not passive investing. It is a highly active and technical approach that exploits the mismatch between macro realities and price. To summarize, David Tepper's approach is neither pure technical analysis nor dry macro analysis. It is macro-driven and liquidity-focused price dislocation trading. This system teaches us this. The market sometimes acts like a boxer who has lost control and begins punching everything in sight. While ordinary traders try to dodge these punches, Tepper calculates when the boxer will tire and which macro data point that moment will coincide with. Following the movement of price is easy, but analyzing why the price is wrong requires true mastery. This is exactly what David Tepper has been doing for half a century. He hasn't just read the lines on the charts, he has read the human psychology, the credit markets, and the cold realities of the business world that create those lines. If you are looking for the most important lesson to integrate into your own system from this broadcast today, it is this. Before opening a trade, you must have a discipline filter, a macro confirmation, and a margin of safety. Opening a trade just because a line was broken is like trying to find your way in the dark. However, if you follow liquidity, identify mispricing with logical data, and wait patiently for a catalyst to arrive, you will level up in your financial journey. David Tepper has shown us that to beat the market, you don't need the world's most complex software. You need the most solid chain of logic and the ability to silence the market noise. Patience, correct asset selection, and macro price alignment. These are the 3 keys to financial success. I hope this comprehensive analysis has brought a brand new breath of air to your investment strategies and your perspective on the market. Remember, moving fast in the market can sometimes win, but being in the right asset at the right time, based on the right data, always wins. I wish you profitable and disciplined days where you can see that true value beyond the charts and focus only on the meaningful signals while silencing the noise. May you always stay one step ahead in this journey of developing your financial literacy. Until our next podcast, goodbye.